You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. Today, we're strapping in for a bit of a high-speed tour through a really chaotic global market digest. It's jammed with domestic policy shocks, major tariff announcements.
Yeah, quite a mix.
So our mission is clear. We need to unpack the consequences of this formal U.S. government shutdown, filter through a busy run of international data, and analyze some fresh, sector-specific trade policy cross-currents. We really want to know how global markets are translating all this right now.
It's definitely an unusual morning. The spotlight, it's shifted almost entirely onto Washington, D.C.
Why is that specifically?
Well, mainly because Chinese markets are closed for Golden Week, so that usual financial push and pull we get from Asia, it's muted.
Ah, right. Makes sense.
So that means all the attention is focused squarely on two things. First, how long this Washington funding lapse is going to last. And second, how it's going to complicate this week's lineup of really crucial U.S. data releases.
Like ADP and ISM.
Exactly. The private payroll report, ADP, and the ISM manufacturing survey, that's a key leading indicator, for the health of the U.S. economy. We're really dealing with a complex cocktail here, where domestic dysfunction is driving what happens in the external markets.
That's a perfect setup. So let's unpack this, starting with the main domestic story, the government shutdown. Our source material confirms the political dynamics. The Senate rejected the House's short-term funding bill.
Yep. That was the final step.
And that action formally cemented the federal shutdown. Agencies have already started executing their contingency plans.
And this led to a key insight right away, especially in currency trading. The dollar, the greenback, it actually softened into the European morning.
Which is interesting, right? Usually you'd expect the opposite in a crisis.
Exactly. If you're used to geopolitical crises, this is kind of counterintuitive. Historically, the dollar acts as a safe haven asset. It firms up when uncertainty rises globally.
So what does this tell us?
Well, the fact that it's softened here suggests participants see this crisis not as a global risk needing safe haven buying, but more as a risk of domestic dysfunction.
Ah, okay. So it's viewed as a U.S.-specific problem.
Precisely. It's a political shock, not necessarily a fundamental economic one right now. And that tends to push capital out of the country, forcing traders to brace for, data delays and just general uncertainty.
That reframing is critical. The market is essentially penalizing U.S. policy chaos.
Yeah.
Okay, moving across the FX board then, we saw some interesting dynamics. The euro edged higher.
Yeah, but not really because of anything strong happening in Europe itself.
Right. It seems like it's just waiting for clarity from the September flash HICP data. That's the inflation reading for Europe, and a heavy slate of ECB speakers later this week.
And that raises a good point, though. If the euro has no real domestic impulse, doesn't that make its gain purely technical? Maybe quite volatile?
Good question. Seems like it's just benefiting from the soft dollar for now.
Yeah, seems that way. Meanwhile, sterling firmed up after repeatedly probing resistance around the mid-1.34s.
Okay, for those listening who aren't currency traders, what does probing resistance actually tell us about sterling's near-term outlook?
It means sterling kept trying to break above a specific price level, one that's been established as a barrier, but it kept failing.
Right.
So when a currency keeps bumping against resistance like that, it signals there's bullish pressure, but it's being capped maybe by big institutional traders or hedging activity. The fact that it finally firmed up suggests some of those protective caps started giving way.
And helped by a quiet UK data calendar.
Exactly. No negative noise coming out of the UK data to stop it.
Okay, now let's look east. Things are always a bit more nuanced there.
Indeed. Dollar yen, for instance, drifted lower. It briefly dipped below the 148 mark.
What was the catalyst?
Primarily the Bank of Japan's Tankan survey that measures business sentiment. And frankly, it landed pretty mixed. It wasn't strong enough to really compel a more hawkish repricing in the currency, meaning the survey showed businesses are feeling uncertain. That wasn't convincing enough for investors to think the BoJ is suddenly ready to hike interest rates soon, which kept, downward pressure on the yen.
And wasn't there something in the Tankan commentary about U.S. tariffs.
Yes. In intriguing detail, the commentary noted that firms in Japan are divided on how U.S. tariffs will affect them.
Wait, so Japanese firms are divided on the impact. Doesn't that suggest that this U.S. policy uncertainty itself is becoming a factor in major investment decisions? Maybe slowing down the Japanese recovery even before tariffs hit.
Absolutely. That uncertainty itself creates friction. If key corporate players don't know whether they should adjust supply chains now or just wait, well, it freezes capital spending and hiring.
Right.
That indecision is sort of embedded in those Tankan results.
Got it.
Meanwhile, the Australian dollar was softer. That was partly due to revised manufacturing readings dipping lower. And yes, the thin liquidity because of the China holiday definitely played a role too.
Even though the RBA sounded hawkish just the day before.
Right, even though the Reserve Bank of Australia had kept a mildly hawkish tone about inflation risks just the day before, shows how sentiment can shift quickly.
Okay, before we leave FX, there was a key piece of high-level coordination news, wasn't there? Something about the South Korean one?
That's right. A joint U.S.-South Korea statement focusing specifically on the one's backdrop. They made a pledge to reserve intervention only for genuinely disorderly markets. And they agreed to exchange information on their operations monthly.
So signaling coordination.
Yeah, it's a clear signal of strategic coordination. That's a major step forward in financial diplomacy between the two. But, and this is crucial, the sources emphasize it, this coordination effort did not establish a bilateral swap line.
Which is the real safety net for liquidity.
Exactly. That's the gold standard for providing immediate liquidity. So coordination, yes, but not the full backstop.
Okay, so the dollar is softening because of Washington dysfunction. But that dysfunction isn't stopping the administration from taking very proactive, very specific steps on trade. Let's pivot now to trade policy, because the details of these new tariff measures seem complex and pretty far-reaching.
Yeah, the White House has definitely been busy detailing these sector-specific measures. It looks like they're hitting the wood and furniture industries first.
What are the numbers?
We're seeing a new 10% tariff slapped on softwood, timber, and lumber. That's set to be effective from mid-October. They also indicated caps of 15% for both EU and Japanese wood categories that are covered within existing trade deals.
And the furniture sector is getting hit hard too, right? It sounds like a strategic escalation there.
That's exactly the right word. Strategic. Cabinet and furniture measures are moving ahead with specific numbers. We're talking 25% tariffs on vanities and kitchen cabinets, taking effect in October. But here's the critical part, and this is where the policy really becomes leverage. The cabinet tariffs are set to jump sharply to 50%, and certain upholstered furniture tariffs will rise to 30% on January 1st, unless agreements are reached before that deadline.
Ah, okay. So that massive jump to 50% isn't really intended to be implemented, is it? It sounds more like a nuclear option tariff designed purely to force negotiating partners to the table now.
Precisely. It's basically an ultimatum with a rapidly approaching expiration date.
And the impact if they do jump.
Well, if these tariffs jump like that, it means the home renovation market, which, has been booming for a couple of years, is about to get a lot more expensive for the average homeowner. It could raise consumer costs dramatically unless supply chains adjust really fast or those agreements get made.
Now, these tools they're using for wood and furniture, the tariffs, the deadlines, it seems like they're applying a similar template to a much more sensitive area. Pharmaceuticals.
Yes, the administration also detailed its aims for healthcare. They're explicitly pushing to move production onshore back to the U.S., and they want to link pricing to what they call most favored nation levels globally.
Okay, that specific point, most favored nation or MFN pricing. That needs clarification for the listener, I think. That sounds radical in this context.
It is radical. Essentially, it means if the U.S. currently pays price X for a drug, but some smaller, less affluent nation manages to negotiate a better deal at price Y, the U.S. administration wants that lower price Y too.
Wow.
Yeah. This fundamentally upends global drug pricing models. It threatens to collapse revenue streams for pharmaceutical companies worldwide, basically forcing them to produce domestically in the U.S. if they want stable access to the huge U.S. market.
It's a clear use of overwhelming U.S. market power. What toolkit are they describing to actually make this happen?
They're outlining the use of both the stick and the carrot, so to speak. USTR and FDA officials described using tariff levers, but also regulatory ones, specifically offering things like priority reviews for firms that agree to either equalize their prices under these MFN rules or critically invest domestically in production facilities.
It's a highly targeted effort then, trying to restructure the entire medical supply chain.
Very targeted.
So if we connect this to the bigger picture, how are other countries reacting to this really specific, proactive U.S. tariff environment? It's hitting everything from timber to life-saving drugs.
We're definitely seeing defensive reactions. Taiwan, for instance, reportedly rejected a request from the U.S. to produce half of its semiconductor chips locally in the United States.
Why would they reject that?
Well, it likely hinges on logistics, the huge capital cost involved, and probably a desire to keep strategic industry control within Taiwan. Meanwhile, Japan's economy minister confirmed that a planned large U.S.-bound investment package would be managed very carefully, specifically to avoid causing any unnecessary FX disruption.
So they're wary of the kind of financial volatility we just talked about with the won.
Exactly. They don't want to stir the pot unnecessarily.
And Europe isn't just sitting back either, right?
No, definitely not. Brussels has signaled it will move very soon to table its post-2026 steel safeguards. These safeguards are expected to rely on what are called tariff rate quotas.
Okay. Tariff rate quotas, TRQs. That's a specific mechanism. Can you quickly clarify that for our listener?
Sure. Think of it like a two-tier system. It's a trade tool that lets a certain agreed-upon volume of steel imports enter the European market duty-free, or at a very low duty.
Okay.
But crucially, any imports coming in above that set volume limit, they get hit immediately with a significant tariff. It's designed to protect the domestic steel industry while still allowing some managed trade flow.
So it shows Europe is actively preparing for a potentially more protectionist post-2026 trade landscape.
That seems to be the signal, yes, embedding protectionism into their long-term plans.
Okay, let's transition now to how the broader commodity markets are trading all these policy headlines and the geopolitical risks simmering in the background.
Right. Well, oil has steadied after a bit of a choppy Tuesday. It's managed to hold a modest upward bias.
What drove that?
The key price action driver here was OPEC. The OPEC Secretariat came out publicly and rejected reports that a core group of members was planning a 500,000 barrels per day production increase. They called those claims inaccurate and premature ahead of their weekend meeting.
Ah, so that killed the speculation of more supply coming online soon.
Exactly. That swift, very public rejection provided immediate support to prices. It countered any idea that supply might rise unexpectedly.
And gold. That seemed to benefit clearly from the flight to safety and that softer dollar we discussed.
Absolutely. Gold extended its, frankly, remarkable run. It hit yet another record high, peaking near USD 3,875 per ounce, before easing back just slightly as some investors, naturally took profits off the table.
Gold is the classic hedge against this kind of uncertainty, both political and financial.
It really is. And copper also managed to stay above that crucial USD 10,000 per ton threshold.
Supported by the softer dollar, too.
Yes, supported by the softer dollar, despite very thin liquidity because mainland China is shut down for the holiday.
No.
That soft dollar is a powerful force right now, seems to be neutralizing that liquidity drag.
Any supply issues?
Yeah, we also saw a specific supply concern added to the mix. There were reports of a fire at Glencore's Lomas Bayas copper mine down in Chile.
Okay, so those are the commodities reacting to policy and supply constraints.
Mm-hmm.
Let's finish with just a quick summary of that taut geopolitical backdrop you mentioned earlier.
Yeah, the background tension remains extremely high across several flashpoints. Diplomatic messaging is still ongoing around a potential U.S. ceasefire framework for Gaza.
Mm-hmm.
Separately, Yemen's Houthis claimed a cruise missile strike on a Dutch-flagged vessel, which obviously escalates maritime risks in the region. And in the Russia-Ukraine conflict, Kyiv reported another wave of missile and drone attacks. Critically, we're getting warnings of a really dire situation at the Zaporizhia nuclear power plant. That's due to power supply instability. The IAEA is actively engaging both sides, trying to restore off-site power to stabilize the situation. It's just a reminder of the immense risks simmering beyond the financial markets.
What a dense digest of information we've covered.
Yeah.
Okay, so to recap for you listening, the main analytical threads today seem to be the dollar softening, not because of global crisis, but specifically because of domestic policy dysfunction here in the U.S.
Right.
We're seeing firmness in precious metals supported by that uncertainty. OPEC publicly rejected news of a potential production hike, which helped stabilize oil prices. And then there are these highly specific, high-leveraged tariff actions rolling out on wood, lumber, and furniture, designed more as negotiation tactics than actual implemented policy, at least for now.
Yeah, that's a good summary. And looking ahead for the immediate future, I think we see three crucial watch points that tie directly back to our analysis today.
Okay, what are they?
First, Tracking the duration of this U.S. funding impasse is absolutely paramount. The longer it lasts, the more likely the dollar sells off further.
Makes sense.
Second, we need to see how today's ADP and ISM reports shape expectations for Friday's big NFP jobs data, especially once the official timing gets clarified post-shutdown. That timing is still a bit up in the air.
Right. The data releases themselves could be delayed.
Exactly. And finally, keep an eye on any late-breaking moves or, statements from OPEC members ahead of that weekend meeting. They're clearly trying to manage price stability very actively.
Excellent context. And here's a thought for you to take away as you process all this information. Building on that pharmaceutical push, we talked about the push for onshore production and most favored nation pricing. We really have to consider what could be the unintended global ripple effect on medical supply chains if other major nations start adopting similar domestic priority mechanisms to protect their own industries.
That's a profound thought. If the world really fragments into these regional medical supply spheres, all dependent on local production and local pricing laws, that global standardization, and maybe more importantly, the rapid response capability we saw or needed during the last pandemic, well, if that could just vanish.
Raising serious questions about drug access.
Drug access, innovation timelines worldwide. Yeah, it could get complicated fast.
A critical question indeed for supply chain managers and policymakers alike. We'll catch you next time for the next deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.